How's everybody doing? Mr. Anderson here. We're going to continue our discussion going deeper and deeper into the relationship of stochastic price and EMAs. So basically, this process is a deep one. It's one that some people are going to pick up fairly quickly. Most don't. Most realize over time that they're getting it more and more and deeper as time goes by. Some have to expend really just a tremendous amount of time because you'll hear me say till I'm blue in the face that this might be the one of the most important relationships there are in technical trading. And I say technical trading because this is something that we can basically derive a specific analysis from, as opposed to a psychological element. So in technical trading, this is one of the strongest because it gives us some information that we can look to try to trust, right? And when we say trusting information, what does that mean? Does it mean it's 100%? No, 100% would be binary, right? Binary meaning it's a 1 or it's a 0. It's never that. In trading, it's always, and you'll hear me again repeat this till I'm blue in the face, it's always maybe in a best case scenario 70 to 75%. But if we know that we can achieve that type of level, if we can utilize tools that give us that type of success rate, well, then there's mathematical laws that allow us to know that we have no issue. We're going to be fine. We're always going to make money. So how do we do it? Of course, sound risk management, but once we go beyond that, we've been going deeper and deeper into this relationship of stochastic as it relates to price and EMA, and specifically the 200 moving averages, the EMA and the moving average. And right now we're going to talk a little bit about specifically resets. Now, what's this guy talking about? Mr. Anderson talks about a reset. Well, what's a reset? A reset's pretty simple. It's when you get to this technically oversold or this technically overbought and you get a cross, right? Now, some resets are full resets where you cross from here to here. And that would be a full reset that takes you from one end to the next. Where others are partials, where you go from here and then respond. Now, why does this matter? See, I'm going to break this lesson down into a few different things. First, I'll talk about the fact that understanding the bull and bear control zones, if we're above 50, any type of reset, if you study, and it's important to go back and look at charts, especially when we have these type of conversations, take a note and look for yourself. Now, typically, if you're in the bullish control zone, a reset in the bullish control zone, meaning a recross. So let's say here. Now this is a bear reset. So we have a bear reset. Uh-oh. Let's stay on alert. What's happening? What's happening? What's happening? And basically you end up having another bull reset and an immediate bear reset. Now the fact that this bear reset occurred in the bearish control zone is even more bearish than the downward pointing reset itself. What do I mean by that? Well, very simple. Let's just look at this area just for proof in the pudding, right? We can just highlight that area. And what happens? You get a giant dump, right? It doesn't mean it's always going to happen that way. Of course not. But the point is, it's more bearish than just simply going either straight down or having that reset occur up here. And the reason's pretty simple. You basically were pulling back for a while, bulls started to step in, and you have a lot of new bulls, right, that stepped into price that immediately realize, uh-oh, I was wrong, and they're adding to the selling pressure. So you end up getting basically a doubling of that supply because the people that just bought in also won out, right? Not all of them, of course, but some of them. So it ends up helping the speed of the downward motion because you can see from here to here you had this giant move in Stoke, but it only netted you from this point a few hundred dollars, and then of course when you had the recross, it basically was about triple that, and just covered a little bit of area because this is the bearish control zone, and this is the same for all time frames. It doesn't mean it's always going to happen that way, and in fact, a lot of times it does not happen that way. And when it doesn't, when it's pretty clear that there's not further weakness, that's when your bull divergences will come in, or if we're talking about top side, your bear divergences. So what do I mean by that? Just a quick example. Some of them won't show up on these divergence type charts, but give you an example of momentum before price type of scenarios, and sometimes the price follows along. Maybe it's just equivalent price and momentum, but right here, you got a recross here, right? Now you did get one sharp candle, but it didn't follow through. Hey, that's a bullish scenario, right? Doesn't mean, hey, I'm going to buy, but, recross above 20, maybe you're going to feel pretty good about this because you went up, failed, it didn't make a lower low. Hey, that's great. Once it crosses that 20, Now you're feeling a lot better. You're not out of the bearish control zone, but you have an upward slope. You survived a recross in a very bearish territory. That might be a reason for some success. And if you remember at this time, this is a weekly time frame, we had this huge run up. It ended up getting bought down a little bit, but still, we started to see some of that immediate interest in what that is. Basically, more than likely, I can't say for sure, but likely that's pros jumping in an exciting manner and taking a hodl type of position just based on that kind of format. So very important, right? So write that down. Understand that. A recross during a reset, meaning you're resetting down to the bear side. You've now bullishly tried to make a reset to the upside, right? You want to get used to these terms. And that immediately recrosses back down to the bear side. That's going to hold normally more water. And when it doesn't, then it usually also implies the possibility of a momentum change, which is good. So again, not binary, right? Nothing binary there. We didn't say something that's just hard and factual. It's just things that can help us to instinctually make some better trades. Now, what else does that tell us? Well, it also tells us some interesting things, which is, hey, do you want to be long on a bear reset? Well, we'll talk about that, and the answer might be more surprising than you think, but uh, I would put it this way. It depends on your trigger trade, right? What does that mean? Remember, guys, anchor chart is the chart that you're basing things off. Then you've shrunk your time frame. So whether you started on a weekly to make your diagnosis and your analysis, and then shrunk that down to a daily to make a decision on the play, that would be the anchor, and this would be your trigger. Same thing. If you did it on the daily and you went down to 4 hour, 6 hour, 12 hour, whatever you choose, this would be your anchor, and that's your daily. So on your anchor chart, right, you're going to want to make sure that you're in a pretty good position, which we'll get deeper into. But on your trigger chart, the one that you're taking the actual trade on, I would absolutely not look to sit through any type of reset. Now, I'm going to give you some caveats to that, but basically, look at this. We're above the 200. This gets a reset on this 4 hour chart, and it dumps off completely, right? So same thing, same scenario. Why do I want to sit through a reset? I don't, right? Sometimes they won't be so bad. It's true. But ultimately, why would I want to reset on my time frame? Now, sometimes you'll switch time frames, right? So you might say, hey, look, I started off on a 4 hour trade way down here. And as it progressed, I started to look at it more as a trigger trade, meaning the trigger chart on a daily because I wanted to give it some room to run. That's kind of a different conversation and one we'll have later. And if you did that, that's fine. Then this would become your trigger. But ultimately, on a normal circumstance, if the 4 hour was your trigger and things were moving along nicely, and you got a confirm bear break right here, right, a bear cross followed by a breakdown of that 80 number, that key number, because we're not just looking for the bear cross, because we know that if you're above the 200, you can kind of live up here for a while. But I'm going to be on guard if I don't cover immediately. I'm going to be looking to cover on the bear break that now crosses to the south, meaning to the downside, that 80 number. Okay. Now I'm still in the bullish control zone. That's true. And a recross would be quite bullish, and I could jump back in that situation. It's okay. But and the key is one of the reasons I'm doing this today is that, I don't want to just think about the smaller time frames. We utilize them a lot because it gives us a lot of data. But we're going to look at some of these higher time frames as well to kind of give you an understanding of how that plays out, because it plays out exactly the same. We just don't have a lot of data to look at. We'll end up looking at the same examples over and over if we always use the higher time frames for the teaching moments. But I'll give you an example. So this occurs right here. This is a good idea. Let's say on the daily, you were in a situation where this was your trigger chart, right? So you might recall on the daily, we had an interesting situation here where we basically had the 200. Trust me, it was above the 200 here on the weekly, but below it on the daily. And there was some skepticism leading into the breakout. Even by me, I was looking for the possibility. It doesn't matter when you watch this video if it's 4 years out. In this situation right here, there was some skepticism to wonder, like, hey, is this thing going to run out of gas? I had some scenarios where it might run out of gas, come back down, and then make another run at these 200s. But things were looking very well. We didn't see a price breakdown. It was holding the moving averages good. So I didn't really get a reason to sell there at all. And then what ends up happening is at this point, you could have sold here based off this exactly what we're talking about, which would have made sense. But then what you'll notice on the recross, you would have bought here. Now, I'm not zoomed in, so I know it might be very difficult for some of you to see this. I just know it's going to mess up the screen on all the other charts, but it's okay. So basically what that would mean that we basically said, hey, we don't want to sit through a daily reset, so we covered there on this break. Well, look what happens. You end up going down, feeling good about the fact that you got out, but then there's this big move to the upside, which also caused a bull recross. Now, in this case, believe it or not, you would have bought back in at a worse price than what you sold, more than likely. And that's okay. We don't trade to be perfect. We don't care exactly where we bought and sold and if we sold here and bought there. You sold here for protection because you didn't know if it would dump through. You bought here because now the new setup looked interesting again. Now it made its way back up into this bullish control zone and heated area, technically overbought on that scale because it was above the 200, but we had this unique situation where we basically, and I'd have to look at the 4 hour, but I know on the 2 hour, we basically were in a situation, I gotta lower this. Yeah, so we had our lower time frame above the wait, yeah, the 4 hour was above the 200. The higher time frame was above the 200. Interesting situation, right? But our trigger chart was below, so still we're on guard. But you had this tight doji, a really clean day that didn't give you an exit. This was a clean day before it broke out. Well, actually, it broke out pretty early in that day, and then boom, you had that massive burst, which happened in a very short time period. But the idea is that getting in on that recross could have led to something like that. It doesn't always have to be $1,000 candle, but the idea is that it does show that you can have that significant bullish action in the bullish control zone. And then, of course, to add to that key, we also had our higher time frame in good position in the bullish control zone, and we had a lower time frame in great position in the bullish control zone, right? So if these stories can add up and basically paint you a picture that makes sense, then great. Now, it's not always perfection. It's not always going to line up just perfectly. You could wait for all the perfect ones if you'd like, but in trading, look, we're going to try to stretch it a little bit here and there. We might see that, hey, this time frame looks okay, but really I need it to climb a bit, and you might try to front run it a little bit, which means you might get in a little earlier than the perfect signal or the confirmed signal, and that's okay if you are disciplined in your approach and say, look, if it doesn't show me what I think, I'm going to get out. But the moral of this story is that I can get out on these resets, right? Even now, I'm above the 200. I still don't want to be in on this reset right here necessarily, or at least I would want to hedge, right? So right here you get a recross and it does pull back a little bit and then finally eventually kind of recrosses again. So again, slightly higher price and you could have got chopped up a little bit in here, but you're getting out on some of these recrosses. So again, there's some chop, but ultimately what it ends up allowing you to do is to catch some bigger moves and then get yourself out on any type of recross and eventually catch another bigger move when you're crossing back bullish. Now this one was back into the bearish control zone, but this is good to show us why. We were trying to reset. It didn't make a full reset on the daily right here. And if I'm going too fast, again, feel free to rewind, rewatch it, etc. But ultimately, we didn't want to sit through this reset, so we didn't. And it turned out to be good. The first move was kind of sharp because I think this was that tether operation, and depending on what day, month, or year you're watching this, you might remember that. But basically, there was some news-driven event, but that would have gotten you out, which is good. And then the next day was the one that was ugly. It might have been vice versa if I'm misremembering. I apologize. But either way, the point is you were looking to get out on any cross. So if that was the case, there's a chance that you avoided that. And then ultimately, as it started to stabilize on a recross, here you are, your recross. You are in the bearish control zone at this point. But remember, our goal is to avoid resets. So now technically there's a bit of a bull reset again, right? And we're in a situation again where now we have the upper time frame doing a great, just swimming up in the bullish control zone, and we're hoping that it's going to upturn. If that happens, great. At scale, there's going to be a big move, and of course, if you're looking at this chart, you could see there was a huge move, right? And that's the idea. If we could try to catch that, if we could try to anticipate that, hey, my higher time frame is already in that bullish control zone. So if this one's making a bull cross and can get up there, that's going to allow this guy to bull cross as well. And now suddenly, I call it the Autobahn for bulls, right? Meaning things just get really exasperated. You could see some sharp moves. And in this case, this is an example where you went from about 5,200 up to 9,000 over that period of time. But we're comparing time frames, right? So in this situation, what happened with the the 4 hour. The 4 hour came down and had a bull cross as well. So at that time, in this very same moment in time that we're talking about, you had your lower time frame in a position towards right around 50 with a bull cross, and your higher time frame above 80 with the potential of making a bull cross way up there. So it made sense. You didn't sit through a reset. Sometimes that means choppiness. Sometimes that means getting cut in and out. And it might even mean missing some moves. But ultimately, you want to be very careful. Now, you can get out of that reset just in case and watch your lower time frame, of course, to try to jump back in if you were really interested in hoping not to miss any movement. Because the lower time frame is going to show you the bull reset first, right? So by all means, you might have waited on this 4 hour right there. As you can tell by the price being flat, the cross happened quicker on the 4 hour than it certainly did on the daily, which of course makes sense. But the idea was that lower time frame could then get you in on that new cross. Okay, and this is all about relationship. This isn't about perfection. This is about the understanding of this relationship between this momentum indicator and price itself, and basically leading you to basically sense that momentum, right? If I say basically a few more times, forgive me, I'm sure I will. But the idea is that that is a key with all of this, and when we're dealing with trading, we just want to make sure that we're finding a relationship that can make sense in our mind. And you can look at it basically on any time frame. You know, if we go to a more recent scenario here. Okay, so this is a 15-minute. It doesn't have to be a 15-minute. It doesn't matter if that's what you're looking at, right? But ultimately, what occurs here is this: you basically are in a situation to where, in this point in time, the weekly scale is now bear cross. Now it's way up in the bullish control zone, but there's a bear cross to it. At the same moment in time, the 15-minute chart is testing the 200 and possibly going to fail there because it's getting to what we call an overbought situation. And why is it overbought? Because it's below the 200 or fighting with the 200. Now, everything else is done pretty well, right? Excuse me, this is an hourly. I'm calling it the 15-minute the whole time. The hourly chart right here is fighting that. And at the same period of time, the 4 hour, which is right there, was basically trying to make a comeback, but that comeback was happening within, I'll zoom in more, the bearish control zone, right? So if we can understand this relationship and say, hey, look, the 4 hour above us is in the bearish control zone. So if this is my trigger chart, in the bear zone, even a little bit of a bullish cross, understanding can be helpful, but that's what got you from here to here. When we start to see that weakness, this is where that moving averages come into play. So now this trigger chart of a 1 hour, if that in fact was our trigger, is going to point us to a direction where we say, wait a second, here we are on the 1 hour at the 200, a critical juncture, right? In a situation to where we might be overbought, and then also starting to begin to show further weakness in the moving averages. Now, you may not have made it to this point in the first place. This just happens to be a pretty good example because if you were in earlier, you did get to a position where you started to see a breakdown in the moving averages. But let's just say for whatever reason, and I'm sure you could think of many, there was a reason to kind of jump back in. One of them might be that the 4 hour was recrossing and you're trying to anticipate a move higher, and that's okay. We look to buy dips in what is a bull market, and at the time of this video, this is a bull market that's going through a bit of a trend change here, but it's trying to find this ground. You get a lot of choppiness, and you do have to take chances in those situations. So that chance might have made sense. But ultimately, when you do that, you do it on guard, right? Because what you really want to see is this thing leap across that 200, and then that pullback would then come back and hopefully hold now those 200s and allowing to keep you a positive upslope. But instead, what occurs, it actually fails at the 200 and the 55, and you start to see it peel back. You see smaller candles. That's also a little bit of a warning sign, right? Because there's bearishness. That basically means that there was supply there. And then ultimately it starts to peel back a little bit. And once you start to lose that level, this would be a good short opportunity. It would certainly be something where you'd want to get out of a long. Of course, it's easy for me to say in hindsight, right? But this is trading. This is how you learn trading, is to look at the past and to understand those circumstances if you can make sense of it in an orderly fashion. And we can. We can do that perfectly here, which is great. And what we end up seeing is what? Instead of what would hopefully have been an implied bullishness, it ended up seeing a near overbought position, which maybe got to overbought and then was rejected. So either way, it didn't make it there, which is even weaker. And the fact that you had that bear cross, even if you were a little late, it might have been somewhere in this stage on this candle, not this big one, you certainly would have been out if not short, and put yourself in a position to where now, if we look over here on that 4 hour, you see where that line is. We're seeing that we're likely seeing that bear cross again as well. So that showed us what? The first example of this video, which is now we're bear crossing in the bearish control zone, which is even more negative, and that's why you get the sharp decline. So the key here is understanding, one, we don't want our trigger to basically reset on us, right? Why? There's no point in sitting through that on your trigger. Now, if you're on a low time frame, that means you're going to be getting in and out pretty quickly. But it's very important to make sure that that's not the case. However, I want to throw you a caveat, okay? Are there exceptions? It's not really an exception that I'm saying, but one thing that's a little different is this. Now, let's say your trigger in this example was the 1 hour. Okay, so here I am. I'm in the 1 hour. I'm going to try to find the same example on the left side. There it is. Okay, so don't worry about how squished the data is. You can kind of see, and I assure you that you can see well enough to understand what I'm looking at. So basically, if you see this level on the very left side, not where I'm at, but the actual left-hand chart, hey, right there, you might say that's about to reset, right? Which is true. But you're in the bullish control zone on the 1 hour, which is the second chart, and the 4 hour, which is the third, on the 4 hour, which is my second chart. I'm messing this up for you. And then the daily, which is my third chart, and even the weekly, which is my fourth chart. Now, granted, those could be sloping down, so you have to watch out for that. So this might not be the greatest example, but the point I'm making is that if your higher time frame is in good shape, if your hourly is your trigger, or your higher time frame, your 4 hour in this example is your trigger. So the 4 hours is a trigger in my example, and you have an upslope, let's say it's like something like this, and you see, and it actually occurs here. You see this upslope? This is exactly where you get to this, not overbought because you're above the 200, but this situation where you're having a bit of a reset, right? And what we see is it comes back down. The reset gives it another sharp move up, but this is all occurring while this guy is upsloping. So we always want to give them a chance to run. Doesn't mean you can't take some profits. Maybe you say, hey, look, I'm going to take 25, 50% off the table. And I don't give you specific numbers because that's something we'll talk about at a later date. That's strategy. But for the time being, by all means, take a portion off. Don't think about being perfect. Just cash some profits in. But the idea is you do not have to, because you can trust your higher time frame in this situation because that's your trigger, right? So if your trigger is the 4 hour in this example, finally said it right, and the 1 hour is showing a reset, you have the right and the discretion as a trader to decide if you want to sit through that reset, knowing that, hey, maybe that reset will only go down halfway and reset in the bullish control zone and give me a bigger move, right? So you might anticipate that. Or it may come back down and instantly be what? Oversold, right? And then I can feel good because I have my trigger still in the bullish control zone, and we're going to have a pop back of some sort. You might even add to your position once that occurs. So that is a thought process that you'll want to look into as well. Is that, look, if my trigger is upsloping in the bullish control zone, then perhaps my lower time frames can reset. That's understandable, right? Just like a daily. So now I'll give you that same example. Once the daily was up here, we didn't have to be too afraid. I wasn't afraid, right? You guys heard, if you recall this time basic. I wasn't afraid during this time. I could see the possibility of bullishness. Why not? Because in a situation to where you have bull scenarios, the strong get stronger, right? So we have to look out. We have to be smart, of course, but you could be in a situation to say, hey, once you took that 200, maybe I'll allow, and I'll try to find where that is. That's right about here on this 1 day. So on the weekly scale, let's say if you're trading on the higher time frame, you might say, all right, well, what's going to happen with my daily? Well, once we cross those 200s, we start to see the possibility of a reset right there. Now, remember, I'm talking about having a trigger of a weekly, okay? Went over the same example where my trigger was my daily, and in that situation, I do not want to sit through my reset. But if my trigger was my weekly, different scenario. I might give it some room to breathe, right? I'll put a stop loss of some sort. I don't want to drop, 20% of my position or whatever it might be. But the idea is that I'm going to give it some breathing room. Why do you do that? Because you could have this example that we're learning in this video occur to give you extra bullishness, or the reverse is the same on a bear side. So, and this happens a couple different times. It looks like, oh, okay, well, it didn't reset there. It's certainly going to reset here. And there was some, obviously, some downward movement. But what happens? You get another bullish reset, right? And this one drives you even much further. So even this one, you basically now, I'm willing to sometimes, depending on my time frame, let them reset the whole way because I'm comfortable enough that there's enough of a distance there. Of course, if you're worried about breaking a parabolic trend or things like that, that's a different scenario. But we weren't quite there yet. We weren't in a position at this point in time to call this thing parabolic. So I felt okay, and then I'm just saying by looking at this chart as if it were any chart, doesn't matter. I would feel okay in saying, hey, look, I'm okay with this thing. I have a higher time frame idea in my mind. I'm not going to wait for a lower low, let's say, as an example, on a closing basis. I would cover there. So I'll have some reasons to cover. I wouldn't want my 55 to break as an example. So you can come with several ideas, but doesn't mean you can't give it the breathing room it needs to pull on back. Now, maybe I sold 25%, 50% here. I'm watching now the rest of the position go, and then what ends up happening, it finds some support, recross in the bearish control zone, but the higher time frame was not. The higher time frame, which was our trigger, was actually in the bullish control zone. And you end up getting a rocket ship, right? And that won't always happen, but that's how you can participate in a trend for a longer period of time. It's not always going to do this, but ultimately it doesn't matter the time frame. If your trigger is in good position, upsloping and bullish control zone, then by all means you have the ability to give it some breathing room. Now you'll want to be careful as they hook. Hooking is a little bit of a worry sign, and I would be paying closer attention, obviously, on this cross in that situation. Doesn't mean I'm out because remember, we don't want to just see a cross. It would be a cross followed by a close under the 80 mark. That would give us the majority of concern. But ultimately, again, remember, not binary. We're talking about a few different elements that are sound, very sound principles, right? Sound in the 70, 75% range, and sound enough for us to create strategies and knowledge in our mind to say, look, because of this, we can begin to read the ebbs and flows of the market and have an understanding that, look, life up here can mean this type of movement, right? Just like life down there can mean sharp movements if we're under the 200. But also look at all your time frames. Look, above the 200, above the 200, above the 200. Believe me, this guy was. It's just that this chart doesn't show it. The 200s were over here. But the idea is that you have a situation where you can safely say they were above. So because everyone else was, except for this particular time frame, you can give it that breathing room. So we definitely want to understand that relationship, and we want to truly review this in detail and go back and look at either majorly successful moves, right? And terrible moves, meaning drops, because you want to learn the downside action too, right? And what I'm going to tell you is this: learn this, write some notes on this video, maybe watch this one a couple times, and try to understand the principles that I'm speaking about. And then go ahead and allow that to translate to another asset, another market, another coin that moves quickly, whatever it might be, and look for a trending scenario and try to keep, if it's just two of them, that's fine. If you can go to three, great. If you can go to four, that's fine. Three is fine. Go to three, like a 4 hour daily, a weekly, something like that. With crypto, it's a little difficult to find weeklies that are in great shape, so you won't find too many of those. So you can look at the bear side for a lot of them. Just go back in time and kind of understand, and you'll see a lot of this. You'll notice that a lot of this existed, where you're in a situation to where you say, all right, well, look, if my trigger was that, and it's okay to do hindsight trading, right? We'd say, look, if that was my trigger, how would this have played out? And you could see and watch that stochastic and that relationship too. Don't forget the relationship of moving averages. I just don't want to go too deep into one video where it goes 2 hours long. I like these to try to be a little bit more condensed so that you can rewatch them a few times if you're totally lost. But the idea and concept is very strong because it's what leads to the rest that's needed to build on this is going to end up being what? Potential energy, right? And you already have built up just glorifying, not here yet. You were right. This was right there, right? So you start to basically have this beautiful move, which we didn't know about at that time. It was like this, but this beautiful move was building on this highly weekly scale. And then ultimately it ended up putting us in a position to where you needed a rest on the lower time frame. The time frames came into that perfect alignment that we discussed, and that is where the power comes from. Why? Well, because the guys that are trading the weekly are long. The guys that are trading the daily just became long. The guys that are trading the 4 hour are long. The guys that are trading the 1 hour are long. The shorts that got short are burnt and now they're buying, right? It's all about flow, cycles, flows, how the market moves, an understanding of that, etc. They call it chop for a reason. That means you have people on both sides that are just fighting the time. It means the time frames are fighting. And what you're going to learn is the more and more you learn this, the more detailed it's going to become in your mind, and the better you're going to get at this. You're going to get very good at just seeing this and understanding the flow. And a lot of times what that means is it's going to allow you like to come up and say, all right, well, like, well, I'm going to kind of change subjects slightly, right? In that forget predicting a move now. What allows us to then look at this here and say something like, you know what? Now here's where things get a little tricky. Understand that. Like, what are we talking about? Well, it's pretty simple. Our lower time frames, right? That 1 hour, just as an example from this point, right? The 15-minute, the 30-minute, the lower time frames lost their 200, right? So what's that mean? Well, that means that they are working on one set of rules where where oversold doesn't exist anymore. It's only overbought that exists. And the higher time frames are working in the opposite world where only oversold exists. And that creates a scenario of chop where you end up in a situation you can, and even the 3 day, which I'm pretty, the 3 day has some different things going on with the EMAs versus the 1 day, which looks perfect, and the weekly, which looks perfect. The 3 day actually has some things to do at this moment in time of me making this video. So don't worry about that now. I guess I could try to show you that guy. Let me just put it here for a minute and then I can come back. Oops, nope. That's not going to let me. Regardless, the point is I show you on that, but this is key. Obviously, this is all key, but it just helps you to understand the ebbs and flows of the market and to also be able to point out things like choppiness, right? To say, hey, why do I know that things are going to be a bit choppy? Well, because now that we have time frames that are arguing with each other. So that's what allows us to say, and then sometimes you get that choppiness, and you still get a burst up, right? And then all right, still consolidating, we're still getting some choppiness because there's work to be done. Now, if the lower time frames can make up enough distance when they have the opportunity to be bullish, remember their opportunities are limited. Why are their opportunities limited? Well, their opportunities are limited because they're below the 200, and as long as they're below the 200, they have the chance of getting overbought, right? I do want to find, let me see what's going on here. I'm on a setting here that's not going to allow me to, anyway, I'm doing this on a big screen, so from what I'm seeing is a little bit different from what you guys are seeing. But regardless, I can use this 1 hour as an example, so I apologize for not being prepared with that. But the idea is pretty simple, which is this. If you're in a situation where you have the 1 hour now working on a subset of understanding that, look, it can hang out down here and it can stay down here for a while and have accelerated moves, but it's not going to hang out up here very long, probably 4, 5, 6 bars at the most, sometimes a lot shorter. So what that means is you're not going to make up a lot of ground once you get up there. You have to do your work quick, right? Again, same scenario as when we were very bullish. The bears had to do their work in quick dumps so that they can make their way into bearish territory on some time frames. Well, now in this case, the 1 hour, once it lost this level, what do you see happens? You start seeing topside action there before it even got to overbought. Then when you get to overbought, forget it. It's not going anywhere else. Now it didn't even make it. We lost, and it gets ugly, right? If you don't make it back, you recross. That's ugliness, even though that's in bull control zone. And then finally here, a nice big run, but it fails, right? So there's a pullback. You can't hang out very long, just a few bars. And then nice bull move, right? A bull cross again in the bullish control zone, which is good. And unfortunately, it gets stopped out again, not coincidentally, right at that 200. in overbought position, and it has to do it again. Now it's a little bit of a moving average squeeze happening at this point in time of the making of this video, and perhaps it gets squeezed up. It is resetting, which is good, but it has to be careful with the resets. Now that's the difference, right? A bear move under the 200, you have to be very careful because this doesn't mean oversold. It could mean that it's going to hang out, and you might have to wait until one of the higher time frame shows oversold. Just to kind of flip that a little bit, this is the bear scenario. Well, what do we see in the bull scenario? Right? We can squeeze this chart up. We can see it's been above the 200 the whole time, and it doesn't take much to see, even with this small squeeze view that I have, is that every time this thing went oversold, it bounced. Oversold, it bounced. It bounced. It bounced. It bounced. It bounced. And you didn't get anything resembling anything like this, and this is a weekly scale, which is amazing. And why does this occur? Is because it is not overbought. It is in a bull market on that time frame, right? Same thing over here. This is not overbought, no matter what we want to say. I know we have to call it overbought because it's our only point of reference, but as much as we want to call it that, the reality is that's not true. This is just simply high momentum, high stochastics, right? This is oversold, right? Look what happened. Immediate bounce out of there. Doesn't mean we can't go much lower. Doesn't mean we can't get a very sharp turn. We already discussed that, right? That's the lesson of this video, which is, hey, if we bear across now, it can get very ugly because that's happening very deep into the bear control zone. So that's the way it has to do its work. It has to bounce out because it's oversold and take another deeper dive. And that's basically how they have to do their work. And then, of course, you're going to end up with more consolidation on a higher scale. So that's enough for this video, right? I hope that rang some bells. Give me some feedback if you could. But ultimately, I think this is one that should help further along that progression that you're looking for. And if not, don't be shy. Take steps back if you need to, right? Because this relationship is vital. Because when I start to get more and more into the application, I'm going to get into some very specific elements of, hey, what does this EMA mean to me? What crosses am I looking for? And it's it becomes more valid when you understand that relationship with stochastic. So it's more nitty-grittiness here instead of just teaching concepts. So I'm teaching a couple little concepts in terms of understanding the idea behind what I'm discussing, but ultimately it is up to you to really just dig deeper and deeper and deeper. I had one of you guys told me recently, and it was great to hear from you, that someone told me they watched a lesson 38 times, right? And I didn't check to confirm that, but I'm going to take him for his word. And he told me he watched it 38 times because he thought he was getting it every time, but he was failing in his application. And then on that 38th time, he saw it completely different. Now, I'm not telling you to do that, and of course that's extreme, and I'm not saying it's going to take that. But a lot of times what it is just a block, right? And it's not that, I give the example of it being another language, which is true. But the other example, as I always do, is repeat my examples, which is that it is another language, but it's not actually the way I describe it, like, hey, learning Spanish when you only speak English. At least there you have a point of reference, like, hey, they both come from Latin, and in English this means that, so there's a possibility that it can relate in this way or the other. No, 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 no. It's very different. This is a new language altogether, right? There is no translation. I'm not translating the word of, hey, this is overbought in that scenario, and it's not binary, and it's subjective 75% of the way, 25% of the way subjective and 75% binary. You know what I mean? So it's very different, and it's understandable that turns some people off. Very smart people get turned off by that a lot. So be careful with that, and just understand that, hey, look, because of the way that it is, you just have to kind of sit your way through it and start to see these little crucial points of, like, hey, I understand that this got oversold at the 200, and then oftentimes after that, a bull divergence will show up on that retest, right here, and that means we're now going to try to move up. And we're running into a little bit of a problem here. Okay, well, let's see what's going on. Let me look at my time frames, etc., and understand the language of what's occurring, and see that, look, there's justifiable reasons, like why when we ran back up, because hey, this should be popping, look, this was a perfect setup. We bounced on this 200. We had the bull divergence. Well, it did pop, right? So first of all, I'm not saying you should have got it perfectly, but if we're going to look at the reality, it did pop from around 74 and change to about 80, 8100 on this scale. I mean, that's a massive move. That's a huge move. That's nearly about 10%, which is an amazing bounce back, if I'm looking at the numbers correctly. But regardless, we can see why. First of all, the 55 is a big deal. You're not always just going to reclaim it on a closing basis. If you could, great, but slope matters, and we see the slope is down. So if you can start to understand that reality and say, hey, look, it's going to be hard to take out that 55, especially when I consider the fact that if you look on the left-hand side, what occurred at the exact same time? I was testing the 200 on my daily, on my hourly, which is above me, which means what? I'm overbought, right? So here I am in an overbought position, putting in a bear divergence. Now, again, don't worry about my tool. As I always point out to you, my tool is not going to show you this all the time. You can see bear divergence much better than any computer can. I promise you that. That's just reality. So being that that's the case, what do we see? Price goes higher. Momentum does not. That is a bear divergence. So now you see bear divergence occurring in an overbought position on stochastic. That's going to dump. This is a perfect exit signal. This is a beautiful perfection exit signal. Now you might say, well, look, it's not confirmed to we get under that 80, and that's true. So it might have been already into that candle. I understand that. I'm not saying you should have exited at the top, but I'm just letting you know that we can look back and say, absolutely, look, we got negative slope on the hourly. Bear divergence was put in not only on this MACD, but also on the stochastic right there, which is very strong. And we had that negative slope. We had a situation where we were testing the 55, and we could put the puzzle piece together. Doesn't mean it's going to dump, but it does mean it will, at the very minimum, take some time. So in this live example, well, then we would want to see this guy go ahead and pull back a little bit, right? Hopefully enough to then go ahead and take another upturn, if you're long, of course, or looking for longs, in this bullish control zone. This is a crucial moment, by the way, just in this point in time. Obviously, this is a lesson that will be watched for many, many months and beyond that. So it won't matter maybe to many when they get to this. But the point is, this is very crucial because you have a squeeze here. This is a moving average squeeze coming on a 4-hour scale. You're in a situation here to where daily is in the oversold position, but it just bounced out. So it has the risk of now recrossing bearish, which can certainly take that down to the 55 at a minimum, which would be about 7,000. So we could see a picture of like, hey, you know what? Somehow here we are. Technically, this is a Friday, heading into a weekend. We're in a situation where we could see a squeeze that pushes us back higher, and certainly a squeeze that pushes it back lower. And you might say, hey, that's obvious. We're going up and down, but it's very different to say, hey, we're going up and down, than to paint the exact scenario as to why. And that's when you become a trader. When you could say, no, we may go up because of this, and we may go down because of that. And when you now know both paths and why, it allows for you to create a game plan to say, look, if I start to see this occur, then that means X, Y, and Z, and therefore I'll take a trade on this occurring. If it doesn't, and the other scenario starts to happen, then that means 1, 2, and 3, and therefore I have this other trade scenario worked out in case that's occurring. Now, you could also stay on the sideline and watch, which is fine also, but that's the point of being a trader, is to have a true concept, a real concept, not some BS, not some nonsense that we watch for a few minutes. No, genuine concept of what's happening and how it's happening and the reason for it, and be able to put it together in our mind and say, all right, because of X, Y, and Z, that's why I can do it. Okay, that's it for this video. It went even longer than I actually expected. Hopefully all is well. Give me some feedback, and we'll be back very soon with a new lesson.